to our ongoing DMI University webinar series, where we explore agent topics related to sales, marketing, and operations that make a difference in your business. And today, with the help of Desiree Buckner of the nationwide Advanced Consulting Group, we will help deepen your knowledge of retirement income planning by sharing potential tax-efficient planning strategies as your clients lead up to, transition into, and draw income in retirement. I'm really looking forward to this presentation today. Really enjoyed speaking with Desiree before this presentation, and then just look forward to the material. And also just want to let you know, don't forget to go to DMI University and our page called Tax Efficient Retirement Income, where you can find this webinar recording tomorrow, and then also some related materials. But be aware, as usual, we're muting and blocking participant video during the presentation, but we'll open it up at the end of the 40-minute presentation for Q&A. Today, we are very lucky to be joined by Desiree Buckner of Nationwide and Phil Ferrara, one of our VPs of annuity sales for DMI. But I'm going to hand it off to Phil for a few words. Thank you, Phil.
Thanks, Glenn. Just to give you a little background on Desiree. Desiree joined the Advanced Consulting Group at Nationwide in 2014, with over 25 years of experience in the financial services industry. She's responsible for advanced technical support in the areas of annuities, IRAs, trusts, distribution planning. She also supports life insurance in areas of estate planning, charitable gift planning, long-term care, general business planning. In 2015, she obtained her certification for long-term care. Desiree was also Assistant VP of Advanced Markets at AXA Equitable for over 8 years. Prior to joining AXA, Desiree was a senior attorney with the legal division of the Federal Deposit and Insurance Corporation. And Desiree received her BS and her law degree from Louisiana State University in Baton Rouge, Louisiana. I believe that's the LSU Tigers. Am I correct, Desiree?
You're right. I bleed purple and gold.
That's great. Desiree has been a great resource for many of the advisors I work with over the years, as well as some of the other people at Nationwide's advanced planning team. They're all exceptional in regards to their knowledge and help in utilizing annuities and life insurance as part of the planning process. So Desiree, thank you for joining us today for this webinar. And I know everybody, including myself, will get a lot of great information. So I'll leave that at that, and you can get started. Thanks, Desiree.
Thanks, Phil. Thanks for those kind words. We really appreciate that. Our goal at the Advanced Consulting Group, as you know, is to help in any way we can, but mostly to provide you with sales strategies, advanced sales strategies, and technical and tax planning, and basically just whatever you may need. We are here to help you. And we have a group of like 13 of us. And everybody does a little bit of everything, but then we all have sort of specialty areas where we have depth. So together, and we work together all the time. Together, we can usually help you with about anything your client cases may need. We are part of Nationwide's Retirement Institute. The presentation that I'm doing today is part of a series that was produced by the Nationwide Retirement Institute called Tax Efficient Retirement Income. You may also hear TERI, the acronym TERI. It's a program. They have corresponding materials that I believe Glenn alluded to that you will have access to. This presentation today is the basic tax overview. You can't understand how to help your clients when they hit retirement on which assets to take for tax efficiency. You can't help them unless you know the basics of tax and how the different tax aspects for all different assets are, so that when you're planning and purchasing these assets, you can do it with a view that is most tax efficient when it's time to distribute. Oftentimes it's too late. When you get to retirement and you start distributing and saying, okay, I need to start taking from my assets, sometimes it may be a little behind the 8 ball to get the most tax efficient retirement income. So that's what we want to talk about today. We want to set the stage, talk about different assets, the taxation, how it works when it's accumulating, then how it works when it's being distributed. And then there's a second presentation that we'd be happy to come back and give to you guys that basically puts that together and says, now, when you hit retirement and you have to start taking those distributions to live off of, this is how you're going to do it to be the most tax efficient. So this is your basic, your foundation. And then if interested, contact Glenn and Phil, and we'll be happy to come back and do the second part of this series, which is more advanced on actual planning strategies for distribution. And of course, we have to keep compliance happy. So please take about 20-30 seconds to read the disclaimers. Okay. Tax basics, that's what we're going to talk about first. We're going to talk about types of assets, how they're taxed during accumulation and upon distribution. So we're going to talk about what and how income is characterized, because based on how it's characterized is how it will be taxed in the future or even currently. Then we're going to talk about how each investment, different types of investment accounts, the tax treatment, whether it's tax deferred, tax free, or taxable. Then last but not least, I'm going to give you a smidgen, sort of like a little teaser, an intro to how positioning your assets and what assets you take and distribute from for retirement income can affect at the time of retirement by showing the impact of different types of income streams and the effect on the taxation of Social Security benefits. So how is income characterized? And first, what we usually do is, okay, how is a particular asset characterized? Is it ordinary income or is it long-term capital gains? So either during accumulation or when you distribute and receive income, how is that income characterized for tax purposes? There are several others, but these are your two main categories. You have ordinary income, which can be active or passive. You have long-term capital gains. You have short-term capital gains. You have tax exempt, and then you have tax-free. But the main two that we're going to be looking at is ordinary income, long-term capital gains, and then I like to also throw in tax-free because of Roth. So when you have investment and retirement income, what types are characterized as ordinary income, and why is that significant? It's significant because ordinary income traditionally and currently has the higher tax rates than capital gain, particularly long-term capital gain. So what type of investments are going to be characterized as ordinary income? And you're going to be looking at ordinary income tax rates, like I said, either during accumulation or when it's distributed. First and foremost, distributions from traditional IRAs and qualified plans. Those are characterized as ordinary income. Short-term capital gains. What is a short-term capital gain? A short-term capital gain is a capital gain asset such as mutual funds, stocks that are held less than 1 year. So you purchase a stock, you sell it prior to 12 months. That's going to be short-term capital gain. So any gain in that stock is going to be short-term capital gain, taxed same rates as ordinary income. If it's held over a year, it's going to be long-term capital gain, and you'll get the favorable capital gain rates that we'll see in a minute. Dividends. Dividends, unless they're characterized as qualified dividends, dividends are taxed as ordinary income. Most taxable interests, like your CDs, interest on CDs, interest on loans, notes, that's going to be taxed as ordinary income tax. And then income from money market accounts, non-qualified distributions from Roth accounts. We'll talk a little bit more about Roth later, but if it's not a qualifying distribution and you take a distribution of earnings from a Roth account, that's going to be taxed as ordinary income. Then the biggie, second to traditional IRAs and qualified plans, taxable amount or otherwise the growth, the earnings in a non-qualified annuity. That is ordinary income. Taxable amount of life insurance withdrawals. We'll talk a little bit about how to efficiently take distributions from a life insurance policy, but any taxable amount growth, if it's distributed while the owner is and insured is alive, is subject to ordinary income tax. Social Security payments. Now, a lot of people say, oh, well, how much Social Security is taxable? Some people say, oh, 85%. Well, we're going to see towards the end of the presentation, there is no general statement on this. It depends on your total income. It depends on the type of income. And we're going to go through how you determine how much an individual's Social Security payments would be taxable. At this point, we want to go through a little bit of a deviation from what we're talking about, but it's very, very pertinent, which is tax tables and rates are driven by whether or not you file single, whether you file joint, married, and whether or not you file married, filing separately. And those are very, very important. And what's very important is for a married couple. And that's the point that we want to make here, which is when you have a married couple, there's a standard deduction. So your adjusted gross income, you get to minus off standard deduction of $27,800. So if you just make it easy, $100,000 of taxable money from an IRA, then we know you have $100,000 of ordinary income tax, of ordinary income. So if you get to take the standard deduction of $27,800, that brings you down to $72,200 taxable income. And that's going to be taxed as ordinary income, the higher rates. What's significant is, and a lot of people when they're doing the planning don't account for this, but when one of those spouses dies, the next year when they file, they're a single taxpayer. So that same $100,000 that's distributed from an IRA, you only get a $14,250 deduction because you're filing as single. Therefore, that same $100,000 distribution is going to be taxed on $85,750. So it's just something to remember when you're dealing with your clients and there's a death of one spouse. Their tax bill is likely to go up. Let's look at the tax brackets, and you'll be able to see difference between married and single, and most importantly, how with that $100,000 that we were talking about, married filing jointly falls into the 12% category. Because remember, it was around $72,200. So $19,900 is taxed at 10%, and all the rest will be taxed at 12%. But then after that, one of the spouses dies and they have to file single, we're in this column. So you see that same $100,000 distribution. Now, only 9,000, or about 10,000 gets 10%. Then the difference, so about 30,000 is at 12%, but now we got almost 40,000. Actually, a little over 40,000, that's going to be taxed at 22%. So you see the difference here, how the death of one spouse makes taxation a lot different. Okay, next, let's talk about the other big category, which is capital gain or loss. What is that? Basically, capital gain or loss is the difference between the basis or the original investment. I'll use an example. You buy a mutual fund and you purchase a mutual fund at $10,000. That is your basis, your cost basis, tax cost basis. All those terms mean the same thing. Purchase price. Annuity, non-qualified annuity, the contribution. The difference is between an annuity and a mutual fund is here. Mutual fund is considered as a capital asset. Therefore, the difference between the original amount, $10,000 in my example, so now it's worth $15,000. You sell that mutual fund or you liquidate it. The $5,000 of earnings growth, whatever you want to call it, that now is taxed as capital gain. If it was held for 12 months, for longer than 12 months, it will be long-term capital gain, which is going to be a lower tax bracket than ordinary income. In my example, if it's a non-qualified annuity, and I'm jumping ahead, but I think it helps to do some comparisons. If it's a non-qualified annuity that is considered as an ordinary income asset, that same $5,000 growth is going to be taxed as ordinary income. The other thing that's significant here is in that mutual fund, that is growth, appreciation. It is not taxed, even though it's not taxed until you sell it. However, in the meantime, if it generates earnings, either, let's say, a dividend's paid by one of the stocks that's part of the mutual fund, a dividend's paid. Remember what we said earlier? Dividends, unless they're qualified dividends, are taxed as ordinary income. So since it's not a tax deferred asset, earnings, income, such as dividends that are paid, let's say that mutual fund liquidates a stock to buy another one. That's a taxable event. Therefore, you may then receive, even though you didn't take a distribution, you may receive appreciation that is now realized, and that would be taxed as long-term capital gain if you've held it for long enough. So as you see, there's different categories of taxation with even in an asset, depending on when it's realized. So these are all things that need to be looked at when you're investing now, because I'm going to now flip you and say, okay, let's say that was in a non-qualified annuity. Yes, the growth, appreciation, whatever is going to be ordinary income. However, it's tax deferred. Mutual funds aren't. So since it's tax deferred, when a stock declares a dividend, you don't pay tax. There's no earnings that were distributed to you at that time. So I like to try to show the difference. We're going to talk about non-qualified annuities again later, but I like to show the difference because it depends on what the client's goals are. Client says, I don't want to pay any taxes, or I want to pay the least amount of taxes while it's in accumulation phase. Then you may want to look to a non-qualified deferred annuity, because no matter what happens with the mutual funds or whatever that the non-qualified annuity is invested in, you don't pay taxes until you distribute it. Income is characterized, as I said earlier, as long-term capital gain, gains from investments sold that were held for more than 12 months, qualified dividends, such as common stock dividends. It has to meet certain criteria. And then investments held within qualified plans are taxed as ordinary income. Why is that in here? Because we're talking about long-term capital gain. Because it's a point of confusion oftentimes. If you have, let's just use an IRA. You have an IRA and that has a Putnam fund, it has a Fidelity mutual fund. That mutual fund is sold or you change. Oh, okay, well, that's a capital gain. So how come when the distributions are made from that IRA, that those earnings aren't long-term capital gain? The answer is because it's in an IRA wrapper. When a mutual fund or when an asset that is categorized outside of an IRA as a capital gain asset, if you put it in an IRA wrapper or a qualified plan, now it becomes ordinary income. Why? Because it's tax deferred the entire time until distribution. Long-term capital gain rates. Here's where we can see the difference between the rates as we showed earlier for ordinary income tax. So we still have, let's still look at our married filing jointly. So earlier, we had a $100,000 distribution from an IRA, which was ordinary income. So we had, the first, whatever, 20,000, 25,000, whatever, at 10%. Then we had everything else in the 12% category. Here, that same amount, because the 100,000 had the standard deduction, got us down to 72. So instead, we have the sale of a long-term capital gain asset. So let's just say a mutual fund held more than 12 years. And the capital gains on it, the appreciation, was the same 100,000. So we reduced it down to the 72, back to down saying, when we look at the capital gain rates, married filing jointly, 0% capital gain rate paid up to 80,000. So here you see the difference. How what asset was invested in during the accumulation phase prior to retirement, how that affects what you take during retirement in order to be most tax efficient. Tax treatment also varies by the investment type, as we've alluded to. So you take an asset, not only is it going to be, do you have to look at it as capital or ordinary, but we're going to also look at it as tax deferred, tax free, or a taxable investment. Tax deferred investments are typically IRAs, qualified plans. The growth, I like to say the growth, the earnings on a non-qualified annuity. Tax is not paid no matter what is realized or recognized with these assets until you take a distribution from it. So it's basically voluntary. You take a distribution, well, it's voluntary. We'll get to that until you hit RMDs for IRAs and qualified plans. Then we have tax-free accounts such as Roth IRAs. Roth IRAs, provided certain criteria is met, the earnings and growth on a Roth IRA when it's distributed can be tax-free. You can also distribute life insurance proceeds at death, tax-free. The other thing is health savings account, and this is one that I'll be honest with you, I've been using as opposed to Roth. I haven't bought into yet the idea of paying taxes to convert or not getting a deduction for my contributions. But with health savings account, I actually get both. I get the deduction when I make the contribution, maximum amount of contribution to a health savings account, and then provided at 65 or over, if I want to take this, well, at any time, if I want to take a distribution to pay for a qualified medical expense, there is no tax. So I got a deduction. When I took it out to pay for qualified healthcare expenses, I didn't pay tax on it. Over 65, you can actually take distributions and you pay taxes ordinary income. Sometimes it can also be advantageous, and like I said, to put it in there right now as opposed to Roth. But these are things that you got to do ahead of time. The other thing is the list of qualified medical expenses at the current time is quite liberal. So if you meet certain qualifications, health savings accounts can be a wonderful tax efficient retirement income source. Taxable investment accounts, stocks, bonds, mutual funds, brokerage accounts. Those, like I said earlier, are taxable in the sense of earnings, income generated, such as dividends, interest, or sale. Even if you don't receive it. That's the key. Oftentimes it's reinvested. Even if you don't see it, it's going to be taxable along the way. So what types of tax deferred accounts? As we talked about, we have IRAs, 401ks, such as profit sharing plans, all your qualified plans, profit sharing plans, money purchase plans, defined benefit plans. Most often, those are funded with what we call pre-tax dollars. The participant does not pay tax or gets a deduction, however you want to put it, so that they don't pay tax on the money when it goes into the IRA or qualified plan. Some plans allow after-tax or non-deductible contributions. If so, that is not taxed again upon distribution. You can also make non-deductible after-tax contributions to an IRA. Growth. What's most significant about IRAs, tax-deferred investments, including non-qualified annuities as well, is the growth is tax-deferred. So you pay no tax while it's accumulating. You pay no tax until it's actually distributed. Withdrawals. When you take it out, though, you got to pay the piper. So, but think about it. When you made the contribution, you got a deduction. So the concept here is your higher wage earner, higher AGI, presumably higher tax bracket. When you made the contribution, you didn't have to pay the tax. When you take it out, presumably concept here, strategy here is when you take it out, you're in a lower tax bracket. But it is taxed as ordinary income. Permitted with penalty, you can take it before 59.5 from an IRA, but there are penalty taxes. As far as from a qualified plan, sometimes you have to look at the qualified plan, whether or not they allow distributions, even with penalty. There are exceptions to the 10% premature penalty, such as death, disability, substantial periodic payments, age 55, retirement from a qualified plan. Presentation's not on that, but we could actually do a consultation with you at any time you have a client who wants to take a distribution prior to age 59.5. The biggest thing that gets people during retirement is the fact that IRAs, qualified plans, you have to start taking distributions at age 72. So that's where you can suddenly find your client paying a lot more taxes that they don't even need because they have to start taking distributions. That's where planning early on may be significant, such as converting some of those IRAs, qualified plans to Roth. Why? Roth, you do not have to take required minimum distributions at age 72. So that's what I'm saying. That's why planning pre-retirement, how to position the assets for retirement and for what they need during retirement is so significant. If you have any after-tax dollars, either an IRA or qualified plan, money that was not deducted, you don't have to pay tax on that again. However, a lot of people think, oh, okay, well, I'll just take that money and then I don't have to pay taxes. Well, can't do that. They figured that people would do that. So for the most, except for Roth, for the most part, when you take a distribution, if you have both pre-tax and after-tax dollars, it's going to be prorated based on the ratio. So that's one to remember because most people think they can take out their after-tax money and not have to pay tax on it. So IRAs, how much can you contribute? I'm not going to go in depth in all of this because this is about taxation and about how to efficiently distribute for tax efficiency. But IRAs up to $6,000. Now, with IRAs, you can always contribute the maximum amount. The issue is whether or not you can deduct it. If you're a participant in a qualified plan, then you are not allowed to deduct it unless you fall within these limits. Same applies to spouse. If your spouse is in a qualified plan, then you also need to fall under these limits, AGI limits, in order to take a deduction. You can also contribute to an IRA for a spouse that does not work. Employer-sponsored qualified plans, you've got, we call them their IRA type plans, SEP IRA. It's where the employer, it's all employer contributions, it's all employer money, but it's made to each participant's own IRA, and thereafter it's treated as an IRA for that participant. Simple IRA has both components. It has tax deferral and or either matching by the employer or a non-elective contribution by the employer to everybody. So it has mixed employer and employee money. Simple IRAs basically are treated like traditional IRAs after 2 years. So you have to have the simple IRA in existence for 2 years, and then it basically falls under most of the same rules as IRAs. Those are typically used by your small businesses. However, qualified plans, those fall under Internal Revenue Code Section 401A. So we call them 401A plans, but they also fall under ERISA. So they have an added complexity, both in terms of rules and provisions, but also in administration. So I like to point that out. And for that matter, oftentimes small, closely held businesses don't usually go down that road with a qualified plan, but they can, they're eligible. So profit share, what are your typical ones? Profit sharing plan, those are not required to make a contribution every year. So it gives the employer some flexibility. It can be both employer and elective deferral if you add the 401k element to it. So if you add the 401k element to it, or just 401k, salary deferrals only, it's employee money. But you can also have matching or non-elective contributions from the employer. And the cool thing about profit sharing plans, like I said, is you can change that every year. Whereas a money purchase plan, once you determine the contribution amount, it's mandatory every year. Cash balance is a hybrid type of plan. It's technically a defined benefit plan. The employer bears the market risk, whereas on defined contribution plans like profit sharing plans, the participant does. But the employer on a cash balance plan makes annual contributions and a certain crediting rating. Whatever it is at the end is what you get. And that's what your payout is based on. Whereas a traditional defined benefit plan, what the employer is providing the participants is, I'm going to pay you basically X amount. It's usually a formula when you retire. So it's not, I'm going to put this amount of money in, whatever it grows you get, it's, I'm going to pay you this. And therefore the employer bears the burden of all the market risk. 403B plans, these are other type of plans. It's a similar to a 401k type plan for public education, governmental, or charities. They can have matching or non-elective contributions also by the employer. If so, that falls under ERISA. Typically, they're sponsored by public education institutions and 501c3s. For governmental plans that are not public education, usually look to 457B. They're again similar to the for-profit 401k plan, but they do have specific provisions, just like 403B plans, that 401k plans don't. Tax exempt entities. not a governmental entity, but a tax exempt entity, a nonprofit, can also use a 457B as a top hat plan. In other words, for those highly comped where they don't actually pay for everyone. That's just an overview of your type of pre-tax qualified type plans. Now, big important thing for our discussion, which is retirement income planning, which is you have your 401ks and you've done well in your IRAs that we just talked about, and it's grown great with all this tax deferral. And guess what? You're doing what you want. You're doing the smart thing. You've positioned your assets to where your tax efficient retirement plan, which may be different for somebody else, but your tax efficient retirement plan is to draw other assets to keep your taxes lower. And therefore you don't need the qualified plan or IRA money, so that adds to your ordinary income tax, may even affect more your Social Security, taxation, everything. The problem is when you hit age 72, for traditional IRAs, qualified plans, 403Bs, 457 plans, all of those nice plans required minimum distributions. The government Internal Revenue Code says, sorry, you have to start taking this amount. And for the majority, it's all going to be taxable. So you have to look at that. And when you're doing your planning, you have to account for 72. At 72, I'm going to have to start taking. You may not know exactly how much that is, but you can monitor it over the years and possibly do some strategies that we would be talking about in part 2 of this type of presentation, which is, okay, how can you avoid that? How can you avoid required minimum distributions? One point to make, which is when you're talking about required minimum distributions for IRAs, if you have multiple IRAs, and this comes in more investment type planning, but if you have multiple IRAs, you have one maybe in a fixed indexed annuity, you have one in a mutual fund, you have another in a variable, whatever, for your investment strategy. You can aggregate your required minimum distributions that are required from each account and take it from only one. So if you want to preserve guaranteed death benefits or guaranteed income benefits, whatever, in your investment strategy of your IRAs, you don't have to take it from each account. You can take it from any one IRA. 403Bs can be aggregated together. However, you cannot aggregate IRAs and 403Bs. So you can only do them separately. Most significant qualified plans cannot be aggregated at all. So if you have a 401k at an employer that you worked at 20 years ago, you have to take your RMD from that qualified plan. And then if you have one that you just retired from recently, you have to take it. You cannot aggregate those. So what are the rules? You have to take one every year. When the first one is no later than April 1st of the year that you attain age 72. However, if you wait to April 1st of the year after you turn 72, you have to take 2, because it just means you can delay receipt of it. You still are required to take it the year you turn 72. So this year, 2021, you turn 72, but you wait till April 1st and you don't take it until after 2021. You're fine. You're not going to get hit with penalties, but you also have to take one for 2022. That one you have to take by December 31st. So every year after the first year, you're required to receive that minimum distribution by December 31st. The other thing is there's a 50% excise tax penalty if you don't take your required minimum distribution and you don't take it on time. So that's why it's very, very important. 401ks, 403Bs, and 457. What we like to say is employer-sponsored plans. So employer-sponsored plans, 401A plans, profit sharing, 401k, money purchase, 403B, 457, all that are sponsored by an employer. you have another, it's same rule, April 1st of the year after you turn age 72, but we also have another date, or April 1st of the year after the participant employee retires from the plan that they're working for, not the 401k that you worked at 20 years ago. The one that you're still working for now. So if you have a 401k, like I worked at FDIC eons ago. So my 401k at FDIC, when I turn 72, I will have to take an RMD. If I'm still working at 72, which I may be, for Nationwide, I will not have to take an RMD as long as I'm still working for Nationwide, the current 401k. The still working exception does not apply if the participant employee owns 5% or more ownership in the business. It does not apply to IRAs, and it does not apply to tax qualified plans of previous employers. So now let's talk briefly about tax deferred non-qualified annuities. As I've alluded to before, non-qualified annuities, tax deferred growth. So until you take a distribution, there is no tax. Contribution amounts are after-tax dollars. Therefore, distribution of the after-tax money used to purchase or added to a non-qualified annuity does not incur taxation. There's no contribution limits. There may be minimums based on a product, but from an Internal Revenue Code standpoint, there is no contribution limits. When it comes out, though, it is taxed as ordinary income, and most significantly, it is LIFO, unless it's an old contract. If you have if you have any contract that you come across a client, probably I like to say earlier than 1990 call, because there were from 1979 till like sometime right before 1990, there were a lot of tax law changes with respect to non-qualified annuities that were grandfathered. So if you 1035 an old contract that has a grandfather provision, you may lose a tax advantage. So if you have a client that has a non-qualified annuity issued prior to 1990, call and we'll look into that. But as long as it is, I think 1982 is when they changed it. It's LIFO, which means last in, first out. So when you take a distribution, it's a distribution considered of taxable earnings. You don't get to your cost basis and therefore pay no tax until all the earnings are gone. But no required minimum distributions. So just like we talked about with IRAs and qualified plans, with non-qualified annuities, you never have to take a dime until you die. Then your beneficiaries, depending on who your beneficiary is and their options, they may have to take required distributions, but the initial owner does not. Now, let's look at tax-free investment accounts. Why is that significant? Because what it means is it's not added to your adjusted gross income. And as we'll see in a minute, not only does that reduce your tax bracket, because your tax brackets are driven by your adjusted gross income minus deductions. So if it's never added to your adjusted gross income, you're keeping your brackets lower. Second, as we'll see in a few seconds, well, a few minutes, the impact on Social Security and the taxation of Social Security benefits. Tax-free investments also include some tax-exempt bonds, certain withdrawals from life insurance. With life insurance, cash value. So you're the owner insured of a life insurance policy, you want to take a distribution from cash value. Life insurance, thankfully, is FIFO. So you can distribute out first your after-tax contributions, whatever you used of after-tax money to purchase the life insurance. So you can take that out and it's not taxable. The other thing is you can sometimes take loans, which would not be taxable. Most importantly, unless you have a transfer for value at somewhere along the way, death benefits from life insurance are tax-free. And then, like we talked about, qualified HSA, health spending accounts, health savings accounts, withdrawals, if they're used to pay for qualified medical expenses, no taxation at all. It's classified as tax-free, which again impacts Social Security. Now let's talk about Roth a little bit, because as I said earlier, what is the significant thing for us for Roth is not only is that tax-free, so that's not dumped on your AGI, potentially keeps you in a lower tax bracket, and also can favorably affect the taxation of Social Security benefits, but also no required minimum distributions. Therefore, the maximum amount in your Roth IRA, if you don't have to take distributions, continues to grow, and provided it meets the criteria, all comes out tax-free, not only to you, but currently, right now, also to your beneficiaries when you die. Very powerful. So during, it's tax deferred, but when it comes out and it meets certain criteria, it then will be tax-free. You can put 6,000 a month, 6,000 same, but you can't do 6,000 traditional and 6,000 Roth. 6,000 is the max between both. You can do a catch up. There are income limits. So if your income exceeds, you will not be able to make the Roth contribution. Both types of Roths offer the tax-free distributions. Roth can also be offered in an eligible retirement plan, such as a 401k. You can go up to $19,500, which is your same salary deferral amount. You can't do both tax deductible and Roth. And then you can do a $6,500 Roth catch-up. How a Roth distributions taxed? Roth is FIFO, just like life insurance. Okay, unlike traditional IRAs and qualified plans and non-qualified annuities that are LIFO, Roth FIFO. So this is another benefit. It comes first from your contributions. Contributions were after tax, therefore no taxation. And by the way, if you're under 59 and a half, there's no penalty. Why? Because you never got a tax deduction for that money to begin with. So contributions come out first. Then converted amounts. So if you do a Roth conversion, let's say you weren't eligible to do contributions, or you had a real down year, and so you're going to do a Roth conversion because you didn't have high income that year. Converted amounts come out next. Now, if you were under 59 and a half, and you take a distribution of a converted amount within the 5-year holding period, they are going to go back and nick you for the 10% premature penalty. You already paid tax on it because you paid tax on it when you converted it. So you won't pay tax, but you could be responsible for the 10% premature penalty if you take a distribution of that converted amount prior to age 59 and a half and you have not held it for 5 years. And each converted amount, so if you did a converted amount over 5 years, then each converted amount has its own 5-year period. Then last is earnings. Now, earnings will be distributed tax-free if you're over 59 and a half, and this is one where you only had to have one Roth. Even if you have multiple Roth or made more than one conversion, the original was more than 5 years ago. Then earnings, if you're over 59 and a half, are tax-free. And when you die, death is an exception to the premature penalty, therefore no premature penalty for your bennies, so their age is irrelevant. And as long as the original Roth was more than 5 years, they don't have a new 5-year holding period, they tack on to yours, then they receive the earnings tax-free as well. Now, one difference with Roth accounts within a retirement plan. If you take a distribution, then it's going to be pro rata because it's in the qualified plan, which is kind of why when you have a Roth account in a qualified plan, you may want, and you no longer work at that employer, you may want to consider rolling out. And as long as it's done a certain procedure, you can actually take the Roth account and roll it over to Roth and preserve the Roth there, take distributions, and then it's not pro rata from your taxable accounts. And then, of course, taxable investment accounts are funded with after-tax money. The cost basis is not taxable, but earnings, whether you receive those earnings or not, earnings are treated as ordinary income, capital gains, or tax-free, depending on the product. I'm going to let you guys look at the recording on this. This just goes through all the different ones, shows whether it's short-term capital gain, ordinary non-qualified dividends, taxable interest, kind of what we've talked about. It kind of is a nice little checklist and flow chart that may be helpful for you to kind of summarize everything we just talked about. But in the interest of time, because I want to get to Social Security. Social Security. So this is going to show you what your money is invested in pre-retirement, and therefore what you take out to live on in conjunction with your Social Security can impact the taxation on your Social Security. Everybody says, oh, 85% of your Social Security is taxable. Well, no. Well, how much is? Well, you can't answer that. It depends on each person's tax situation, because you have to determine what is provisional income. That's what determines how much of your Social Security benefits are taxable. So if anybody says, oh, if you make X amount of dollars, then a certain percentage, don't fall for that. You have to look at your gross income. So you add your gross income, not including your Social Security benefits, plus tax exempt interest. So this, you see how what you've invested in and what you're taking out to live on is significant. Tax exempt interest is added. Roth distributions are not. Why? They're tax-free. HSA, tax-free. Then you add excluded foreign income if you have any, and then you take 50% of your Social Security benefits. That determines your provisional income. Here is how the taxation of the provisional income is. Let's just look married, filing jointly. So up to 32,000, 0. 32 to 44, 50%. Above 44%, 45,000, 85%. That's of the provisional income amount. I'm sorry, of the benefit of your Social Security. Okay, let's look at an example. It's easier this way. So our gross income added with our tax interest and our excluded foreign income is 47,000. They receive 30,000 of Social Security benefits. You take 50% of that, so that's 15. So that's provisional income of 62,000. So now we're going to go back to that chart for married, filing jointly and look at it. So 32,000, 0. 32 to 44, which is $12,000. Okay, 50% of that, so 6,000. Then 44 over 44,000. So in this example, 44 to 62, which ends up being 18,000. You take 85%, which is 15,300. So you add those two. So the amount that is subject to ordinary income tax in this example is 21,300. Now, to demonstrate what we were talking about, which is how your other assets and other income that you receive can affect the taxation on the Social Security income, we're looking at the same amount of provisional income here. Look, 62,000. But the growth, your other income is 52,000. Social Security is only 20,000. So you take 50% of that, 10,000. You're still at the same provisional income. but you receive less Social Security benefits. So you had to take more from your other income. Now, let's look at the difference. If we do the calculation like we just did, comes up, remember, 21,300. Well, wait a minute. They only received 20,000. So how can they be taxed and add 21,300? So there's a different way to make the calculation. And to your surprise, it's a big difference. And it's not one you think, which is, okay, 32,000 up to 32,000 is supposed to be zero, right? 32 to 44, 50%. 44, 85%. Well, in this case, because the provisional amount is more than what they actually receive, the full 20,000 is subject to the 85%. So they pay 17,000. 17,000. So it's actually more than in our previous example. More from a ratio standpoint. So that's just a nice demonstration of how what they receive can affect the taxation of their Social Security. Okay, I ran over. I'm sorry, Glenn. Next steps, there's some white papers, there's some other tools that are also available to look at this. And then most importantly, there's a part 2 that goes into more in depth on how you start positioning assets in order to make the most tax efficient retirement income distributions. And of course, please contact to view this webinar, DMI University and your DMI rep. And with that, I'm gonna turn this over to Glenn.
Thank you so much, Desiree. You know what? I love how you break down this topic. And actually, this is one I'm probably going to want to watch again myself. And we probably do need to do that part 2. Yeah. But so for those of you that do want to watch it again, or if you want to direct somebody to watch this, because this is just so rich with information, we're going to have this recording up on DMI University tomorrow under the tax efficient retirement income, or the TERI page. So look for that. And also just want to see if anybody has any questions. So